To me, it doesn't seem late cycle. I think it's actually possibly mid-cycle for crypto. But then I've heard some people say that this crypto cycle could be changing because there's now institutional involvement. And as you know, when you look at a traditional cycle for a risk asset in public markets, not in crypto, there's four cohorts that ultimately drive the top in a price cycle. You know, it's retail, it's high net worth, it's institutions, and then it's family offices. And until all four cohorts are really all in on a sector, you never see a peak.
The global crypto market just faced a sharp pullback. Bitcoin briefly dropped below $113,000, down nearly 3% on the day, while Ethereum slid over 6% to $3,450. Broader altcoins followed suit, with XRP, Solana, and Chainlink all registering steep losses. In total, the crypto market shed over $630 million in long liquidations within 24 hours, largely driven by profit-taking and renewed fears over U.S. tariffs. But even amid this short-term volatility, strong inflows into spot ETFs and continued dip buying suggest that investor appetite remains firmly intact. According to analysts, the broader structure of the bull cycle is still in place, and this could be just another shakeout before the next major leg up. Fundstrat's Tom Lee, a longtime market strategist and respected voice in both traditional finance and digital assets, believes we're not in the late stages of this cycle, but somewhere in the middle. Lee argues that despite recent volatility, institutional demand for crypto is only just beginning to accelerate. He outlines a framework where the full market top doesn't occur until retail investors, high net worth individuals, institutions, and family offices are all fully engaged. Right now, he says, we're not there yet. In his view, Ethereum is still significantly undervalued, especially as Wall Street moves to tokenize assets on its network. He sees $15,000 as a reasonable fair value in the near future. On Bitcoin, Lee remains firm. A move to $200,000 or more is possible if the Federal Reserve begins easing policy in the coming months. In this video, you'll hear directly from Tom Lee as he breaks down why he believes Ethereum and Bitcoin are still in the early phases of a much larger move. Later on, we'll also bring in commentary from Michael Saylor, the chairman of MicroStrategy, whose company continues to accumulate Bitcoin at a historic pace. Stay tuned for the full breakdown, and if you're new here, don't forget to like and subscribe for more crypto market insights and expert analysis. Thanks, and enjoy the video.
To me, Ethereum is being rejuvenated, right? Because we know the community has been galvanized, and we know that there's just an army of interest coming because of the tokenization Wall Street wants to do, and they are choosing to do it on Ethereum. So I think when you think about the future value of activity, it needs to start getting discounted on Ethereum. And I think that's why the price still needs to adjust higher. And I think I mentioned that if we use multiples similar to Circle, you get to 15,000-ish for ETH. And that would just be a today value. So I think ETH is still undervalued. But we also know, I mean, just from a trading perspective, look, there's a lot of people who think ETH has become sclerotic. You know, like it's a stale layer one. There's more things happening on Solana or Sui. But the reality is that ETH is a legally recognized blockchain operating within the US, and it's never had any downtime. I thought it was so interesting that Vitalik on the 10th birthday of Ethereum notes zero downtime. That matters to Wall Street. I actually think that's almost a little bit of a hat tip to Wall Street because banks care about zero downtime. But again, as you know, there's people who have a pair. They like something else and they're short ETH. So I think 4,000 is a line in the sand. But to me, it's just a matter of time.
I know that you're very bullish on ETH. You just said it's just a matter of time. But let's look at the bear case. What happens if we don't get to that $4,000 level?
I don't think it's critical. I think it's like someone who just months ago would have said, well, Bitcoin can't hold 100,000. I mean, how many people said that Bitcoin wasn't going to hold 100,000 because one, there's nothing supporting it or there's no new buyers behind 100,000. But guess what? Bitcoin's 120,000 now. In fact, I think that there's plenty of new buyers for ETH above 4,000. So to me, I think 4,000, if someone's thinking that that's like a level of resistance that represents something super meaningful, to me, I think it's paper.
I was reading an article that quoted you recently, had you describing the recent market rebound as the most hated V-shape bounce in history. Can you just unpack that a little bit for me?
I think every bounce since COVID has been a hated bounce. Because if someone was personally realistic and introspective, they didn't believe we could recover from that initial COVID decline because the world economy shut down. And then when stocks tanked because Fed Chair Powell initiated the fastest rate hikes in history and stocks tanked in 2022, I know that every one of my institutional investors said, Tom, there's no way stocks can come back. Not every, but most, because they said the Fed is trying to engineer a recession. So those two rallies were very hated. This rally, because stocks tanked because of tariff Armageddon. And we have to keep in mind that if you look at political donations or political affiliations, 60% of professional stock investors voted for not President Trump. They voted for someone else. And that means that the stock market does not believe the Trump agenda. And that's why when stocks fell in April and we talked about a waterfall decline, having symmetric bounces unless there's a recession, it was met with skepticism because the pushback was the Fed is not going to unleash liquidity. So there's no way you're going to get a V-shaped bounce. Well, we got a V-shaped bounce. In fact, that is consistent with history. And I think what makes people really hate these rallies is that since the end of 2019, economists have become very important voices in macro decisions for correct reasons. Economists help you decide how an economy behaves when you shut it down, or how you deal with inflation, or how you deal with tariffs. So they are obviously are important voices. But when economists start to tell you that you have a recession and therefore you shouldn't own stocks, keep in mind economists have predicted like 13 of the last 3 recessions. So I think that has made this the most hated rally. And that's why, of course, once we broke to new highs, stocks have been levitating, and there's still a lot of cash on the sidelines. That whole analog applies to Ethereum, by the way.
You just said we're going to see a lot of new buyers above the $4,000 level when it comes to ETH. What do you think when it comes to Bitcoin?
Yeah, I think Bitcoin has now become accepted enough that it's part of people's steady buying. I think there's plenty of now traditional finance investors stacking Bitcoin, and they're buying it every month. And I think that's why it's holding steady here. And to me, for Bitcoin really to make its next quantum move, I do think it's dependent on global liquidity. And so the Fed, as you know, is on hold. But if their next move is to hike, then the entire stock market really is going to have to fight through that. It won't necessarily decline, but it has to fight that. In the Fed argument, there would be, well, the economy is so healthy, I should be raising rates. But the reality is, at this point in the cycle, the Fed should be easing. It's a question of when. And if they begin easing in the fall, then I think that's going to coincide with Bitcoin making a step function higher. And I still think 200 to 250,000 is possible.
What are you watching when it comes to crypto equities when we look at the Robinhoods, the Circles, the Coinbase? What's standing out to you?
First of all, I would say that if I was just to overlay what I see as activity, and that's what's being reported by exchanges, and Robinhood, as you said correctly, is essentially really geared as a crypto play, to me, it doesn't seem late cycle. I think it's actually possibly mid-cycle for crypto. But then I've heard some people say that this crypto cycle could be changing because there's now institutional involvement. And as you know, when you look at a traditional cycle for a risk asset in public markets, not in crypto, there's four cohorts that ultimately drive the top in a price cycle. It's retail, it's high net worth, it's institutions, and then it's family offices. And until all 4 cohorts are really all in on a sector, you never see a peak. And that's excluding the global aspect of crypto. So to me, I think that there's been robust results reported, but I think to me, especially when I look at the sponsorship and ownership of equities like Coinbase or Robinhood, it still doesn't feel late cycle.
Tom Lee's outlook on Ethereum reflects a broader trend that many on Wall Street are only beginning to price in: the institutionalization of crypto. Ethereum, once seen as just another Layer 1, is now the foundation for real-world asset tokenization efforts. Major financial institutions are choosing Ethereum as the rails for this transformation, driven by its legal recognition in the US and its unmatched uptime. As Lee points out, the platform has operated without a single outage in a decade, something banks deeply value. He believes Ethereum's fair value today could be as high as $15,000 based on revenue models similar to Circle's. And despite some claims that Ethereum is losing ground to competitors like Solana or Sui, he argues that its regulatory clarity and infrastructure-grade reliability give it a clear edge in the next phase of adoption. On Bitcoin, Lee remains equally optimistic. He sees the current price consolidation above $100,000 as a base, not a ceiling. According to him, institutional investors are increasingly stacking Bitcoin in a methodical, recurring way, treating it as a long-term allocation rather than a speculative trade. The path to $200,000 to $250,000, he argues, hinges on one key factor: global liquidity. With the Federal Reserve expected to pivot from rate hikes to easing later this year, Lee believes that shift will provide the tailwind Bitcoin needs to make its next major move. He also draws parallels between the recent equity rally, what he calls the most hated V-shaped recovery in history, and the skepticism that still surrounds this crypto bull run. If the Fed begins to ease and risk sentiment improves, both Bitcoin and Ethereum could be poised for explosive growth. While Tom Lee looks at macro signals and valuation frameworks, Michael Saylor is executing the thesis at scale. As executive chairman of MicroStrategy, Saylor has turned his company into the largest corporate holder of Bitcoin, with over 628,000 coins on the balance sheet. In this next segment, Saylor breaks down the strategy behind their latest multi-billion-dollar offerings and explains why Bitcoin is the new foundation for capital formation in the digital age.
We see Bitcoin as digital capital. The business model of the company is to accumulate the digital capital and then issue digital credit, like preferred stocks, against that digital capital in order to strip the volatility and the risk off of the Bitcoin and provide yield to investors. Here's the way to think of it. Bitcoin is a digital commodity. It's about 50 volatility, 50 ARR, and you want to hold it forever, a 50-year duration asset.
Okay.
If you want amplified Bitcoin, MSTR, the equity, is amplified Bitcoin. People want 2x Bitcoin exposure. The options jockeys love this. The derivatives traders love this. If you want structured Bitcoin, that's Strike, STRK. We give you like the 80% of the upside, and we give you 20% in a structured dividend, and then we give you principal protection. That's for people that would prefer to invest in hedge funds or S&P indexes.
But you're using the proceeds to buy more Bitcoin. You just keep adding on to how much Bitcoin you have. And your average price is what, 73,000?
Yeah, we'll sell a credit instrument like Strike, and we'll buy Bitcoin. So we're taking the volatility and the duration and the upside for our equity investors, and we're giving a structured instrument to the credit investors. Now, Stretch, which is our latest IPO, and I think the most exciting product, it's like treasury Bitcoin. It's for someone that wants monthly dividend, they want principal protection, they want the lowest volatility, they want a high yield savings account, and it kind of competes with money markets or with treasuries. And so what the company has done is we're taking this pure digital capital asset that's got a lot of performance but a lot of volatility, and we're refining it into securities that conventional investors can buy depending upon their risk tolerance and their duration interest. You know, we started and we had very little, and Bitcoin was 10,000, and now Bitcoin's more than 100,000, and 97% of the Bitcoin is worth 10 times as much, and somebody else, not us, has it. Right. So as a practical matter, what we're doing is we're monetizing and powering up this.
I totally get it. I just mean, if you owned all of it, would that change the entire behavior of Bitcoin?
Yeah, we wouldn't want to own all of it. We want everybody else to have their piece. The nice thing there is there's 160 companies that are capitalizing on Bitcoin in the public market, up from about 60 last year. So the Bitcoin treasury movement's exploding. And companies like MetaPlanet in Japan and Capital B in France and Smarter Web in the UK. And then there's a raft of them in the US, Anthony Pompliano's company, and 21. They're all capitalizing. The big idea is I take digital capital, I issue digital credit. And a digital credit instrument can either be longer duration or it can be higher performance. we're offering 9% dividend yield with Stretch. The average money market's 4.2% dividend yield. No one would ever want to give a 9% perpetual yield in a bond that's backed by real estate or backed by gold or backed by any conventional fiat asset. But we're investing in Bitcoin, and my 20-year forecast for Bitcoin is 30% a year.
You know, that all these companies, instead of holding cash or treasuries, they would all hold their money in Bitcoin. If that were true, what would that do to the U.S. government and its ability to operate?
Well, I think the key to keep in mind is Bitcoin is demonetizing foreign real estate, private equity, public equity, other sorts of store of value assets everywhere in the world. 20th century physical analog assets are becoming 21st century digital assets. These companies like Apple and Microsoft, if they could buy the S&P index, they'd be better off. It's against SEC rules.
Right.
If they could buy each other's securities, if the Mag 7 could buy each other's securities, they would be better off. That's against SEC rules. The only security Apple can buy is Apple stock. And what do? They buy their own security. So, in general, if you're trying to create shareholder value, you don't want to park it in a fiat currency. You want to park it in a tangible asset.
Tom Lee's analysis aligns with a growing chorus of seasoned market experts who believe we're still in the early to middle stages of this crypto bull cycle. His outlook on Ethereum and Bitcoin reflects confidence in both fundamental value and macroeconomic tailwinds. Ethereum's role in tokenization, coupled with its regulatory standing in the US, makes it an institutional-grade platform. Bitcoin, he argues, is on the verge of a major breakout, assuming the Federal Reserve shifts to easing in the coming months. But what's particularly important about Lee's view is how it connects to broader macro theses shared by other respected voices in the space. Raoul Pal, former Goldman Sachs executive and founder of Real Vision, has mapped out this crypto cycle into 3 distinct phases. According to Pal, Phase 1 began in late 2022 and ran through the approval of the spot Bitcoin ETFs earlier this year. Phase 2, the current stage, is marked by rising prices and increased institutional adoption, but also increased volatility as markets digest macro uncertainty and policy risk. And now, Pal is warning of a sharp correction this August, driven by overextended positioning, seasonal weakness, and a temporary slowdown in liquidity. He believes this pullback could be the final shakeout before the most explosive part of the cycle begins. Phase 3, as Raoul Pal describes it, is where things get parabolic. Starting in the fourth quarter of this year and extending into the first half of 2026, he expects a full-blown retail-driven mania, amplified by improving global liquidity, interest rate cuts, ETF-driven capital inflows, and technological tailwinds from AI and tokenized assets. During this stage, both Bitcoin and Ethereum could surpass their previous all-time highs by a wide margin. Pal has suggested that Bitcoin could reach between $200,000 and $250,000 during this period, a prediction echoed by Tom Lee, while Ethereum could break into 5-figure territory. What unites Lee, Pal, and Michael Saylor isn't just their optimism, but their data-backed conviction. Lee looks at fundamentals and flow models. Pal analyzes macro cycles, capital movements, and investor psychology. Saylor is executing at the corporate level, using every available financial instrument to turn MicroStrategy into a Bitcoin holding vehicle. Together, they represent the institutional, macroeconomic, and strategic pillars of this cycle. For investors navigating the current volatility, their message is clear. Short-term corrections are part of the process, not a sign that the bull market is over. If anything, they present opportunities for accumulation before the next leg up. With institutional interest deepening, regulatory clarity improving, and the Fed preparing to shift its stance, the setup for crypto heading into 2026 may be one of the strongest we've ever seen. Are you preparing for Raoul Pal's predicted August correction, or are you positioning for Tom Lee's long-term upside? Drop your thoughts in the comments. We'd love to hear your strategy. If you found this breakdown helpful, don't forget to like this video, subscribe to the channel, and turn on notifications so you don't miss what's coming next. Thanks for watching.